Hello kids, I am Sandalu Weerasekara. From this video, I am discussing adjusted cash account and bank reconciliation statements, the theory part, and a simple exercise to understand that theory. First of all, these are my books that I already published, and these are self-study working material books. You can purchase the book from me, do yourself, correct yourself, and then the uncleared things and the errors you can clear by watching the videos, right, through my YouTube channel. And to purchase, send me a message through my WhatsApp, right, 076 562 3763. And yes, bank transfer and cash on delivery is available. Let's go to the lesson. Nowadays, most of the businesses are trying to do their cash transaction through current account. The reason is when we are doing transaction through a current account, the bank itself engaging to a transaction. So from that, we can increase the fairness, trustworthiness, and the transparency of the transactions, right? And in these cases, there's a special thing that we have to assume all the cash transactions we are doing through a current account. But in the practical life, there are cash transactions. We are doing cash in hand, we are receiving cash, and we are paying through cash. That's correct. But when it comes to the exercises like under adjusted cash account and the reconciliation statements, we have to assume that all the cash transactions we are doing through bank current account, right? So from the business point of view, the cash is an asset and the cash account, yes, is an asset. So cash receipts, we are doing debit, and the cash payments, we are recording credit side. But from the bank point of view, are cash in their account, right? So this bank statement that they are preparing for our transactions. So our cash in their hands, so which means our cash is a liability for them. So in bank statement, cash receipts, they are recording credit side, and the cash payments, they are recording debit side, right? So as I discussed earlier, if you are recording the if you are recording the same transactions in cash account and bank statement, the closing balances should be equal, right? But the case is because of these reasons that is not equalizing each other. So in this theory part and in this adjusted cash account and reconciliation statement, actually we have to find out why the closing balances are not equalizing each other, and then we have to adjust that through adjusted cash account and some other errors and some other reasons we have to present through bank reconciliation statement, right? So these are the errors and the omissions and the reasons, actual reasons, and that reasons can be errors and the omissions, right? Okay, so excuse for my English, it's not well perfect like my Sinhala, but I try my best, right? Direct remittances, standing orders, bank charges, deposited checks dishonored, issued checks dishonored, errors and omissions did by the business, check issued but not presented, check deposited but not realized, and errors did by the bank. So we will look these reasons one by one from the next slides, right? Direct remittances. Here what happening, the customers that who have to pay us, they are depositing cash or checks directly to our bank account. So these customers can be sales income, rent income, commission income, or some other debtors, right? Likewise, right? So here, after you receiving the bank statement, then you can identify those direct remittances and then adjusting your adjusted cash account. And the standing orders are the orders that did by the that requested by the account holder, which means the business, to the bank by asking transfer some exact amount to some account on this exact date, right? So these also you can identify it after you are receiving the bank statement and then adjusted through the bank adjusted cash account, right? So actually, the direct remittances and the standing orders at the point of happening, we know that we knew that the direct remittances and the standing orders happen because when those transactions happen, we are receiving an SMS, right? But why we can't record at the exact point of happen direct remittances and the standing points? Because without source document, you can't record anything in your accounts, right? So after you receiving the bank statement, and then you can use the bank statement as a source document to record direct remittances, standing orders, and bank charges as well, right? So bank charges are the charges that bank is getting from us for their services that they provided. So example, SMS charges, card fees, online service fees like that, checkbook charges, it's special for the current account holders, right? Also bank charges you can identify through the bank statement and then uh, adjusted to adjusted cash account, right? And the other reasons are dishonest checks. So dishonest checks can be deposited but dishonored and issued but dishonored. So when you're receiving a check from the business point of view, at the point of receiving the check, we are debiting a cash account. But actually, it credited to our bank statement after we are collecting those checks, and then we have to go to the bank and from the check deposit machine, we have to deposit those checks to our bank, right? So at that point, some checks that can be disowned or that can be unaccepted from the bank point of view. So those are the dishonored checks. So when you are depositing check, so, which means when you are receiving the check, you debit to a cash account, but after that check informed dishonored, the entry that you made at the point of check receiving, you have to reverse that entry, right? So let's get an example here. You are receiving 25,000 check from debtor A. So at the point of that, cash account debit and that relevant debtor or debtor control account credit. But after you inform that check was dishonored, then you have to reverse the entry, which means cash account credit and that debtor account again debit like that. Same happens to the issued but dishonored. So here what happening? We are issuing checks. So at the point of issuing checks, we are crediting to a cash account. But because of some reason, bank is rejected to pay that check. So they inform that the check was dishonored. So at that point, we have to reverse the entry. So at the point of issuement, we credit to the cash account. And when the bank is informed that the check was dishonored, then you have to debit cash account back and then credit the other account as well, right? So the reasons for dishonored checks, there are some: insufficient funds in the relevant account, incorrect date recorded, signature of the check and the system check is not tallied, and the written amount and the numeric amount of the check is not matching, like that, right? And then errors did by the business. So when you are recording the cash transaction, there can be errors or the omissions, right, from the bank point of view. So after some investigation, you have to find out those errors and then you have to correct that errors through adjusted cash account, right? Other two reasons are check issued but not presented and check deposited but not realized. So when the business issues a check for payment, the relevant accounts are debited and the cash account is credited at the time of issuance. As I discussed earlier, at the point of issuance, we credit to our cash account. However, the actual payment is made only when the recipient of the check presents it to a bank and encashment or deposited to their bank account, right? So therefore, although the issued checks are debited from the cash account at the time of issuance, they are recorded in the bank statement only when the actual payment is made. So let us say that we are in May and we issued a check in May. So at the point of issuance, we credit our cash account. But the recipient of our check is not going to present that check in May. He is presenting that check in next month, in June. But at the end of the May, we are receiving the bank statement, right? And we issued that check in May. So at the point of issuance, we credit that into a cash account, but that is not available or that is not presented in bank statement because our recipient is not presented that check in May, right? So those are the check issued but not presented. And a check deposited but not realized. So when the business receive a check at any point, at the receivement, we debit our cash account. But the actual amount is recording the bank statement at the point of those checks deposited to a bank, right? So here the actual value of the check is only credited to the business's current account after it is presented the bank and cleared or after it deposited into the bank's current account, right? So therefore, although the received checks, so at the point of receivement we debited that to our bank account, but still we are not presented that and or deposited that check to our current account, so that is not appeared in the bank statement. So we're testing again the same example. We received a check in May, so we are keeping that check in our local, so that's it. But at the point of receivement, we debited a cash account, but we didn't present that check or deposited that check into a current account at the month of May. So at the end of the month, you are receiving the bank statement. So in cash account, there's a check that we deposited, which means in the debit side. But that check is not realized in the bank statement because we didn't deposit that check to a bank account like that, right? So both of these cases, check issued but not presented and the check deposited but not realized, are not an error, not an omission or some error that happened by the bank or from the business. That is the process. That is a way of process that happening the bank transactions, right? So these are not errors. So that's why we are presenting these reasons through the bank reconciliation statement. If it is an error that which made by the business, so we can adjust that through a just a cash account. But these are not the errors. These are the reasons. Yes, because of these reasons, the cash account balance and the bank statement balance is not tallied. But these are not errors. That's why we are presenting these transactions, these reasons, these two reasons through bank reconciliation statement. So from the bank reconciliation statement, we are presenting why still adjusted cash account balance and the bank statement balance is not tallied, right? You can get the clear idea from the slide. Let's move back to the next slide. So here again the first slide. Cash account and bank statement. So the closing balances should be equal to each other, but because of these reasons, that is not equal, right? So we discussed already the reasons of one by one. So direct remittances, standing orders, bank charges, and the depositor checks dishonored, the issued checks dishonored, and errors and omissions led by the business. So these reasons are errors or omissions which happen from the business point of view, from the business side. So we are preparing our cash account, so which means we can adjust the cash account as well, because their cash account is prepared by the business. If the business prepared the cash account, so we can adjust that, right? So these reasons, which mean errors and omissions that done by the business's point of view, the business, we are adjusting those through adjusted cash account. But still, the adjusted cash account balance is not tallied or not equal to the bank statement because of three reasons. What are they? Check deposited but not realized, check issued but not presented, and the errors did by the bank. So first two I discussed already, and the errors did by the bank I will discuss later. So because of these reasons, still the adjusted cash account balance is not equal with the bank statement balance. And these are not the errors or omissions that did by the bank, did by the business, right? And also these check issued but not presented and check deposited but not realized, as I discussed earlier, these are not the errors that done by the bank also, right? So these cases we are presenting bank reconciliation statement. So from the bank reconciliation statement, we are presenting why still adjusted cash account balance and bank reconciliation statement balance. Sorry, bank statement balance is not equal to each other. Right? Let's go to the formats there. Here, the adjusted cash account format and the bank reconciliation statement format. So cash adjusted account, we are broke for the balance in our cash account and then we are adjusting that. So the direct remittances and issued but dishonored, you have to debit, and the standing orders, bank charges, and deposited but not dishonored, so but dishonored checks, you have to credit, right? Then you are getting the balance here. And in the bank reconciliation statement, based on the information that given in the exercise, we can prepare in two ways. First thing here, we are basing the adjusted cash account balance. We are using the base. We are using as the base adjusted cash account balance. So if you are using adjusted cash account balance, we are adding issued but not presented checks, and we are deducting deposited but not realized checks. Then we can find out the bank statement balance. But if we use bank statement balance as our base, to that you have to add deposited but not realized and then minus or deduct issued but not presented. Then you can find out the adjusted cash account balance. Same thing. But if you use the cash account balance as the base, this is the way that you have to prepare the bank reconciliation statement. But if you are using the bank statement balance as the base, and this is the way, right? And this is the upside down, right? Okay. Let's do exercise to get the full idea of the theories that we discussed, right? So following is the information of Ravi traders for the month ended 31st March 2025, and the cash account given and the bank statement given. So cash account opening balance is 105,000 and the bank statement opening balance is also 105,000. So which means the opening balances of both cash account and bank statement is equal to each other. That is not the error. There is not an error and it's all equal to each other. But the case is cash account closing balance is 283,000, but the bank statement closing balance is 298,000. That is the case. So cash account closing balance and the bank statement closing balance is not equal to each other. So in this case, we have to find out what are the reasons why the cash account closing balance and the bank statement closing balance is not equal to each other, right? So in this case, as I told you earlier, cash account debit side, you have to compare with bank statement credit side. And cash account credit side, you have to compare with bank statement debit side, right? So in this case, cash account, the opening balance is all okay. Sales, commission income, and debtor B both appeared in the cash account and the bank statement. But debtor A, rent income, and the debtor C, these receipts are only appeared in the cash account and not appeared in the bank statement. So from the credit side, purchases, administration expenses, creditor Y is also appeared in the cash account and the bank statement as well. But creditor X distribution expenses and creditor X payments are only appeared in the cash account and not in the bank statement. And the additional information says debtor A and creditor X were dishonored as well, right? And in the bank statement, debtor D, direct remittances, insurance, leasing, those are the standing orders. And dividend income, direct remittances, bank and checkbook charges are appeared in the bank statement, but not in the cash account. So the things that I highlighted here are the reasons why cash account closing balance and the bank statement closing balance is not equal to each other. So here we have to prepare the adjusted cash account and reconciliation statement to adjust the errors and omissions and justify why the balances are not equal, right? Here, in the adjusted cash account, the balance that broke forward from the cash account is 283, and that is the balance that you have to adjust, right? And here, first of all, yes, in the bank statement, there are direct remittances. So direct remittances, you have to debit to the adjusted cash account. So debtor D and dividend income direct remittances, you have to debit to the cash account. And the standing orders and the bank charges, you have to credit to the cash account. So standing orders, there are insurance and the leasing and the bank and checkbook charges. And then in the additional information, it says debtor A and creditor X checks were dissolved. Debtor A means a check that deposited but dishonored. So at the point of deposited cash account debit, and when it's dishonored, you have to reverse the entry. So just a cash account should credit debtor A dishonored check. And creditor X is a check payment. So at the payment, cash account credit, but when it dishonored, you have to reverse the entry. So which means cash account should credit, sorry, should debit. Then you are getting the balance, but still the adjusted cash account balance and the bank statement balance is not equal. Here the adjusted cash account balance is 262,000, but the bank statement balance is 298,000. There is a difference. Still there is a difference, right? And the reasons for that difference we have to present through bank reconciliation statement. And here we are using adjusted cash account balance as the base because we know that. And actually, yes, we know the bank statement balance as well. But in this case, we use the base, we use adjusted cash account balance as the base, 262,000. So if so, we have to plus the issued but not presented checks, and then we have to minus deposited but realized checks. Then you can find out the bank statement balance. So if you record these all correct, if you prepare the adjusted cash account and the reconciliation statement correctly, at the closing point, the bank statement balance, it should be equal to the bank statement balance at the that appeared in the bank statement that you received, right? So that's how. So here at the first place, I told you that I am discussing a simple exercise. Yes, this is a very simple exercise. This can be very complex at your exam. Here, this is the exercise I put into this theory part to understand that theory I mentioned and we discussed earlier, right? So this is a very basic exercise, but you have to practice a very complex exercises for your errors. Right, darlings? Yes, there are two more slides. Yes, from here I'm discussing the errors did by the bank. So nowadays, this is a very, very, very rare, but still occur, and my responsibility is to teach you the things that uh, can have in your exercises, can be in your exam paper, right? So errors did by the bank. So these errors, yes, the bank errors, we can't adjust that because the bank statement is prepared by the bank, and bank is a third party that is out of control from the business, right? So what we can do here, we can present those because the errors did by the bank is one of the reasons why the adjusted cash account balance and the bank statement balance is not equal to each other. So we can present that as a information, as an information through reconciliation statements, right? So if you use adjusted cash account balance as the base, you have to do the error that did by the bank as it is. If they added erroneously, you have to add here. If they deduct erroneously, you have to deduct here. Then you can find out the bank statement balance. But if you use the bank statement balance as the base in the bank reconciliation statement, you have to adjust the error. So which means you have to do the correction of the error. If they deduct erroneously, you have to add. If they add erroneously, you have to deduct like that, right? And the last slide. bank overdraft. This is a very special thing that we have to discuss under uh, bank theories, such as the cash account and the reconciliation statements. So, what is a bank overdraft? When there is an insufficient balance to make payments for the check issued by the business, bank temporarily covers the payments through an overdraft facility. So this is a service provided by the current account holder, provided by the bank to the current account holder. Yes. So let us assume that we have the balance 100,000, but we issued 150,000 checks. So bank is paying for the total 150,000. And at that point, they are giving us 50,000 out of facility. It's a liability for the business point of view. And when we are clearing that liability, so which means when we are paying that overdraft back, we have to pay an extra amount. What is that? Overdraft interest, right? So this overdraft limit provided by the bank is determined based on the collateral securities or the trustworthiness with the account holder with the bank. And at the opening date, when we are presenting the bank overdraft in a cash account at the opening date, it's a liability. So it should appear in the credit side. And the uh, closing transactions, the balance carried down, you have to show in debit side. And in bank statement, the overdraft appears as a negative balance within the brackets, right? So that's it for that. Those are the theories that you have to know and just a cash account and the bank reconciliation statement. So this is a small part that you have to learn in grade 12 under primary books in local syllabuses. Yes, in local syllabus, and also for the London syllabus, they have the just a cash account and bank reconciliation statement, but the terms can be a slightly different when it comes to the London syllabuses, right? So, yes, if you learn something, even a word, please do a comment because the comment is the only gift, only the thing that I am receiving from this, right? And do share with your friends and suggest some theory parts that I have to, so I will discuss in further, right? So we will meet from another theory part and check my YouTube account. I upload a lot of past paper discussions and my books discussion. And yes, purchase the books from me and share that information to friends as well. Right? So until we meet again, good luck, study hard, uh, practice hard, and do your best in every day. Right? All the best, Alex. See you.